All right, so last week we did the team question, and I told you I wanted stronger answers on duration, convexity. Do you have a stronger answer today? What's duration? No takers? Right, average time maturity using the discounted cash flows as weights. It's a measure of interest rate risk using what formula? Using the formula minus duration times some change in yield. So its focus is on what risk is it focused on? But what thing about interest rates? The direction, whether they're rising or falling. All right. What about convexity? The second order. Why? Because duration changes when interest rates change. So this is second dynamic. It's a measure of interest rate risk as well, but its focus is what? Not on the direction of interest rates, but the volatility rates using the formula, and you have to have that whole formula, right? They're really, really critical processes. For exam one, you can give me a good enough answer, which is fine. I'd rather have a blow me away answer, great answer. So I'm running upstairs to Dr. Karen's office or Dr. Faynot's office. We can't believe undergraduate student wrote this, but we'll see. Someone blow me away. There's plenty of stuff on the internet. You just type modified duration or Macaulay duration, you'll have all kinds of websites come up. Some of them are completely unreadable because it's pretty quantitative mathematical stuff, but some of them are pretty readable. So a really critical concept. All right, before we finish up US stocks, just real quickly, the markets aren't open today, so I can't talk, at least the US markets aren't open today. But what I think is interesting, we were talking about this with a group earlier. We're going to start this blog on markets every Monday at 3 o'clock. We're going to meet and go through this. What's interesting is the big story has been large caps have been beating small cap. Growth has been beating value, but small cap has done great the last 2 weeks. Is that enough for a new trend? I'm hoping so. Values outperformed for 1 week. Is that a new trend? I hope so. But what did we see last week? Some disaster for tech stocks. We're looking at Google, Microsoft, Apple, all down significantly. Adobe was down 12% last week. Akamai was down 14% last week. Is there something going on with tech, or is it just kind of a breather after this major run? So that's what our blog's going to be about. What's the trend, and is the trend maybe changing? That's pretty important stuff. As far as tech, the industries, tech, horrible week, great last year. Communication services, that's where Meta is. Communication service, great. It's not down this last week because of Meta, because Meta actually did okay this last week, but it's down some other stocks in there that are struggling. That's where Google is. Energy's back up. Bonds were down last week. Bonds are down last 12 months, but corporate bonds are actually up. So that means spreads must have narrowed, because if interest rates are up, but corporates are up, that means the risk-free rate's up, but spreads have narrowed. So that's why corporates are up. So now we're going to talk about US versus non-US. Well, Japan has been the big story, up 39% the last 12 months. In US dollars is only up 25%. So the dollar strengthened. So if you invested in Japan, you would have been up 39% in yen. But when you convert it back to dollars, you would have lost 10% on the yen. So you'd only be up 25%. But Japan has been a strong story. Someone pointed out to me, Japan announced a recession last week. It doesn't seem like it had that much of an impact. Japan still had a great week. And this is after that announcement. So Japan seems to be zooming. The big news, we know in the US market that it hit a new all-time high. Japan's getting close. When was the last time Japan hit their all-time high? What year? Anybody know? It's before you were born, if that helps you. So 1989 is when Japan last, it's been 35 years, if I did the math right. 99, 09, 19, no, 24 years. 89, 99, 2009, 35 years since Japan was last and they haven't gotten there yet. But if you're writing a paper about the week and Japan hits a new record, that would be huge news because it's been 35. It hasn't been 35 years for the US, has it? Been a couple years, so that's huge news. So we'll see if Japan can do that. That's in yen, so in dollars it won't be quite so great. So I don't know how you say a new record if you're looking at it in dollars. IFA did pretty well this last week, so we see another shift. US down, everything else is up except for China. We know China's really messing up and continuing to mess up, but we'll see if that trend can reverse. Emerging markets are down because that's where China is, but there are some markets up a bunch. So I'll show you a little bit later. There's a really great chart you can do in Bloomberg that lists all the markets around the world, and you can sort them by best to worst and get some real quick. And you can do it in local currency and in US dollars. So you can see what that difference is. So I'll show you those charts. So let's talk about the US. Anybody remember bucks? Beta. So that's focused on what? Two types of stocks. No, that's style. Beta's focused on cyclical and defensive stocks. And then the C, capitalization, what are the categories there? Large, mid, and small, and then micro, okay. And then the S, style, that's growth and value. Which of those growth and value, which is the high quality? Growth. Value is low quality. And then the U is US versus non-US. What subcategories do you have there? Developed, emerging, frontier markets. All right, so if you go out to Amazon or Fidelity, they have international stock funds. They have global stock funds. Anybody want to guess the difference between a global stock fund and an international stock fund? What do you think is the difference in those two? Are they the same? They're almost the same. There's one huge difference. What would you find in global that you're not going to find in international? Frontier. No, global can have frontier. US, exactly. Global includes the US, international excludes. So if you see the Vanguard International Stock Fund, you will not have the US in there. If you see global, the US will be in there, okay? Which is important because if you have a US stock market portfolio and you want to buy international stocks, don't buy a global portfolio because you're just adding more US to your portfolio. You want to make sure you do international. Now, international can be developed and emerging, could be just be emerging. They'll tell you that in the title. If it says international, it probably includes emerging, but it doesn't have to, but they'll have that in the prospectus. Which category they get placed into is going to be dependent on how much emerging they have. If they're only developed, then they'll probably have that in their title. Now, there is a growing trend away from categorizing US, developed, emerging, and frontier, and instead looking at stocks globally. Looking at global large cap, global mid cap, global small cap. I think that makes sense with some sectors. To me, energy is a global industry. You got Exxon, but you also have Shell and British Petroleum. To me, they should all be analyzed together. There's no reason to look at Exxon and not look at British Petroleum. And you got Petrobras, and you got the Russian oil company, you got Saudi Arabia. That's one big industry. So that makes sense to me to be global. But if I'm looking at restaurants, it probably makes a big deal if you're looking at US versus non-US and making that distinction. So I think sometimes it works. You remember the word parsimonious. That's all about how are you going to break these up? Are you going to continue to look at US versus everything else, or you can combine them all together, or it's going to be a mix? Some sectors you do global, some sectors you do by the different countries. You just want to be parsimonious. What's going to help you get the best explanation of what's going on risk-wise around the world? The approach I'm giving you, US, developed, emerging, and frontier, is still the most common approach. You'll notice that. In fact, we can go look real quick. So with Vanguard, personal investors. We can look at their answer 3 questions. I wonder what their 3 questions are. So if I can find their site keeps changing. Vanguard sites, about Vanguard. Yeah, I'm not finding it. Get started. Open account. So I don't know where it is. I wish they just had a button to say view our funds. That would make a lot of sense, wouldn't it? Do they have a search button? All right, so here they have domestic stock, international stock. Let's do a list of their funds. And let's only do stocks. They have 125 stock funds. This is something I learned at USA because when I became head of equity, I inherited, I forget, we had like 15 stock mutual funds, maybe not even that many. And my competitor is Fidelity. They had 500 stock funds. And so I went to the sales force, like, what's the difference between us and Fidelity? They have 500 and something. We just have a dozen. And what I discovered, Fidelity has like 40 growth stock funds. We had 1. Fidelity had like 50 small cap funds. We had 1. Why do they have 50? Because there's always 1 doing well and they can market that one. That's what John Bogle means by investors are no longer investors, they're marketers. You have 50 funds, 1 of them's surely going to do well, and that's when you market. And I told our sales force, we're not in that game. We're going to do our best with 1 fund, and that's what we're going to do. But they have 125 stock funds. S&P 500, how would you classify that? Well, they even tell you. They say blend. What word did I use? I use core. Core is a more common word than blend. What I mean by blend has growth and value stocks in it. All right. Doesn't mean it has large and small. What is an S&P 500 fund? That's large cap. All right. Blend has to do with growth versus value. A bunch of S&P. Here's a global fund. So global fund's going to have US in it. They say it's an international class, but if you see global, when you click on it and you go to composition, there should be US stocks in there. They show you the emerging, so they make a big point out of that. North America is in there, 58.5%. You can tell the US is in there, right? If North America is 55%, they're not putting 55% in the Canada and Mexico. So, so global means includes the US. There's an international fund that should not have any US in it. It should be 0 US. So we'll see if we go down to North. And again, see how they emphasize emerging? North America, they say 30%. They better not have any US in there, though. So,
So is that not a good practice for it to be in, but it's not illegal or like when you
global, in my opinion, is the SEC is really, really picky on titles. So my opinion, when the SEC sees global, you have a significant US. And they say international, you don't have US in there. Now, I don't know if they'd actually, we had some pretty big battles. We talked about high yield bonds. I may have told y'all the story, but at USA, our high yield bond manager was finding some really high yielding investment grade bonds. He wanted to buy them, but the SEC wouldn't let him do it because his fund was called high yield, which means he could only buy high yield bonds. And he was like, that's stupid. I've got bonds I want to buy that are triple B rated and not double B. So they spent several $100,000 and changed the fund from high yield bond fund to high income bond fund. So he could buy investment grade if he wanted to. But that's how picky the SEC is. You can't call it a small cap fund and put a bunch of large cap in there. You can't call it large cap and put a bunch of small. You can put some small cap in there, but the SEC say once you go above 10% small cap, you can't call that a large cap fund. You got to call it something else. Here's a developed market fund. That's pretty obvious what that is. Diversified equity, that's probably almost all US. So if it's international, it's going to have the word international in there somewhere. All right, so that's going to be pretty important. Dividend fund. Here's an emerging market fund. Emerging market. They don't really have as many funds because some of these funds are the exact same funds, but if you have 50 million to invest, you get a fund that's a cheaper price.
You said
I'm sorry. That's the word they use. I use the word core, C-O-R-E. Whenever you see blend or core, they're talking about they have a mixture of growth and value stocks. Doesn't mean they're exactly balanced, but it's not skewed too much to one or the other.
What do they mean by expense ratio?
Well, that's just what you pay to have this fund. That's 4 basis points. We'll talk about that later. We're talking about expenses. So 4 is really cheap. We had an index fund not from Vanguard. We had one that was 1 basis point. You hardly even notice it. In fact, you won't notice this 4 basis points because they do securities lending, which probably adds 7 or 8 basis points. So you're probably getting the S&P plus 3 basis points with that index fund. You can see the risk categories. You can kind of guess what they mean by those. Stocks are always going to have a high one. You have small cap growth. Y'all kind of see what these titles mean now. What is this one here? Mid cap, balance between growth and value. Right. So y'all thought I was making all this stuff up, but Vanguard's, and I didn't create this Vanguard website just to make it consistent. This is the way we talk. This is the way we think in here. So they're following my approach, not this new approach. So the new approach, global. There probably are some global large cap funds and global small cap funds out there. That's possible. They're just not as numerous. Usually, global is going to have all different sizes of firms. You could have a global value fund. You could have a global growth fund. Those are possible. The terms value and growth, when you get the emerging markets, somewhat lose their meaning because emerging are just their own thing. But all right, so places you could research more. We already talked about the World Bank ease of doing business. This guy here, Jim Rogers, he's got some good books out there. He has one book called Street Smarts. It's a little dated, but pretty good. His whole thing is Asia. He thinks Asia is going to be the big story going forward. But I don't know if he's changed his opinion given the problems China's having. It's interesting, Japan's coming back after years of doldrums. India has certainly been a strong story, but India's got a major election, all these elections around the world coming up. So that could be interesting. But he's a good one to look up on YouTube and see if he has any interviews. He's one of those people who's so rich, he just speaks his mind. He doesn't care whom he offends. So he's a good guy to listen to. I love this book, Why Nations Fell. It's a really long book. And it's a long book, not because their theory is complicated. The theory is pretty straightforward. It's just they give so many examples over the last many centuries. If you're an investor, you want to know, why did Argentina fail when Japan worked out? What's the difference in those two countries? They both have a major sea coast. Japan, in World War II, that's pretty disaster. You think that would have destroyed them, and they came roaring back. What's the difference? And he's trying to tell you: is it cultural? Is it institutions? Is it access to resources? Is it access to oceans? What is it about these countries that did well? And they have a theory, and they walk through it. So I think it's a really good book, but it is a long book. If you don't want to read something that long, this video is essentially that book, but as a college course. So you can watch that. I think it's in the great courses on their website. I think their courses are a little expensive, but if you don't want to read the entire book, you can watch this video. And this guy, Sharma, I think he's still at Morgan Stanley, but he's written some good books. He also has some really good blogs. So yeah, some good stuff that you can read. This is a short book. This is a really long book. And then this is a summary of that book. Because it was funny, because a student sent me this and said, wow, this is really good. I really enjoyed it. And so I listened to it and said, wow, it sounds a lot like that. And yeah, he references that book quite a bit. And then here's Sharma. He has the 4Ds. He wrote this several years ago, but I think he would still take it. So what are the 4Ds? Depopulation. The world is just not producing enough babies. You can see it. A website. I recommend you watch this TED Talk. See if I can find it. This guy right here, have any of y'all watched this? Y'all seen that before? So I'd recommend you watch that. It's dated. I don't know when he did this. Boy, it's a decade ago. So I wish they would update it. But he talks about why the world population is going to hit 10 billion and stop growing. It's just, and he says there's just a mathematical reason why it can't go any larger than that. So it's interesting. He's got all these yellow boxes that he does. Really good speaker, but it's very dated, but it's interesting. And so that's what he's saying here is we can even look it up. Japan birth rate. So how many children does a husband, I know a couple need to have?
2.5.
Is it that high? I was thinking like 2.1, but
Somewhere a little bit between there, maybe. No.
yeah, because not all children make it to adulthood to have kids. So somewhere between 2 and 2.5 is what you need. Japan's at 1.4. Japan's not having enough babies. It's shrinking. Some people are saying it's going to be 1/2 its size in 2050 that it is today. What happens when a country sees its population shrink in half? And there's Japanese that are just, they're not getting married, they're not having kids. They're like, this is a stressful place to live. Yeah, Japan's going to try to get more immigration, but from where? And, culturally, it's not the easiest place because of language and other things. So, I mean, it's obviously a wonderful place to live, right? It's a very, very strongly institution country, but that's a very low birth rate. U.S. It doesn't give it in the same format, so that's not the number we need. So I wish they would be consistent when they show it. But you can look at different countries. The U.S. is not as bad as Japan, not as bad as Europe. China is actually somewhat shrinking now, and they're having trouble. They're trying to get, they went away from the one-child policy, and now they're trying to bribe people to have 2 or 3. And people are like, no, we're kind of good with 1. And so they're having trouble getting their population to grow again. There are places that are still growing, but every place in the world is shrinking. In fact, once GDP hits about 5,000 per person, people have fewer kids. As we get wealthier, we have fewer kids. It's, why is it? Because if you're having kids to work on the farm, that's a really different motivation than if you're paying for college and all those kind of things, so that's an issue. So he says that's one of the issues is we're not having enough kids. We're not replacing our population, and that's going to be a major factor going forward. Deglobalization, he talks about that and who wins from that. It's interesting. The countries he says wins and lose. He says the U.S. wins on that one and Germany loses on that one. That's kind of an interesting argument. That all this global trade, people are becoming anti-global trade. You're seeing that in the elections around the world, certainly anti-globalization. Deleveraging, all these countries with this massive amount of debt, these governments with massive debt. What does deleveraging do to the economies? If you want to get into that more, one of my favorite people to read, and I highly, highly recommend it, is a firm called Hoisington Asset Management. You used to have to register, but you don't anymore. And this guy, Lacey Hunt, he hasn't done his first quarter, but here's his fourth quarter, 2023. He talks a lot about this deleveraging and what it means and how slow it's going to make. He has some numbers you won't see anywhere else. He's just up here in Austin. I've met him a couple of times, really smart economist. He's pretty negative right there. He's talking about demographics. Population growth is a factor, but the birth rate, formation, and age of coming all matter to economic performance. So there, I didn't know he's talking about that. Smart guy. He's very unusual. Hoisington, I've met both him and Mr. Hoisington. Hoisington himself really credits the firm with Lacey Hunt, who writes these things. But very unusual bond investor. All they buy is treasuries, and all they bet on is interest rates. Almost exact opposite of his competition. His competition is they almost never buy treasuries, and they never bet on interest rates. They bet on credit spread. But this firm bets on interest rates. And so if you're wondering what interest rates are going to do, what economies are going to do, look at this really cool stuff he writes. Really, really, really good stuff. So he talks about, you learn in your economics class, the multiplier effect. You remember that? The government spends $1 billion, there's a multiplier effect, and it becomes 2 billion. He says the multiplier effect is a negative number. When the government spends more, it actually slows the economy down. He has charts that he shows that. Your economics professor would strongly disagree with him. I'd love to see him debate your ecos professor. It'd be an interesting debate. I'm not saying he's right, because he's a lot smarter than I am. I can't really debate him one way or the other, but he has some really, really good stuff in here. But that's the deleveraging side, which he says can be a major force. And then the democratization. We're seeing a whole lot more totalitarian governments around the world, whether it's Erdogan in Turkey. That's kind of scary, isn't it? Who's the guy in El Salvador? Can't remember his name. He's really popular because he's killed all these people. Crime rate's down. When the government kills a bunch of people, the crime rate comes down because you don't count that as part of your crime statistics. Certainly you're seeing Putin, you're seeing President Xi, the whole world is becoming less democratic. What does that mean? In fact, there's surveys like in South America asking people what I think about democracies. We're seeing more and more young populations say, I'd rather have a dictator, just a lot simpler. That's pretty scary, isn't it? So what does that mean for growth and investing and all that going around the world when he has these 4 pretty negative things going on that all look like they're negative for growth? But he wrote it 7 years ago, but go find him. This is from a podcast, Barry Redholz, that interviewed him. You might look up Barry Redholz and see if he's interviewed this guy again recently, or go to Morgan Stanley and see if he's written some blogs. But he does have a book. You can read his book as well. But if you're an international stock investor, these are the kind of things you're looking for. Where's growth in the world? Where are the opportunities? It's about these type of things. It's how stable is the country? Does it have a working population? Does it have a good education system? How easy is it to start a new business? Those are the kind of things you're looking for to try to find great opportunities for investing. So here's the charts I showed you from Bloomberg. So here's the world. This is called WEI. When you type WEI, it brings up all the world markets. And you can click on any one of these and drill down. So if you click on this one, on the Europe side, it brings up Europe. So here's Europe. You can see the different Europe. Europe is pretty green. And the difference between local currencies and US dollars is not that big because the euro and dollar haven't moved that much relative to each other. But you can click on any one of these and look at all kinds of stuff. This shows what happened just the last market. Man, that's a big dump there. And then here's Asia. I don't understand the top one. That's Pakistan. I thought Pakistan was a disaster right now, but its stock market's up 50%. So I guess not. So you can have a disaster going on in the country and the stock market do well. Why? Because it was the worst disaster before. So you can go from a horrible disaster to a not so bad disaster and the stock market rallies 50%. I really don't understand this one. That's Sri Lanka. If you think Pakistan's bad, Sri Lanka's a lot worse. And yet its stock market's up, 17%, 38%, 37% in US dollars. But the one that sticks out is Japan. Japan is up 40% in yen, only 25% in US dollars, but Japan is getting close to that all-time high, which is really, really, really interesting. Their all-time high is somewhere around 39,000. Let's get the exact number. So if you walk into an interview, you'll know. Yeah, you got articles about it. Near's all-time high. Maybe they'll tell her what the all-time high is. But the all-time high, 1989, so 35 years ago, and it's getting close to that 39,000. I don't know if they ever hit 40,000. But somewhere in here, it probably would tell you. So Bloomberg has these great screens. And what most people do is they have multiple. Well, USA, we had 2 Bloomberg screens. My record that I've ever seen was a guy at Credit Suisse. He had 11 Bloomberg machines on his desk, 11 screens. That's a little overkill, but he had 11. So why was he doing that? Because he might have Japan in one screen. He might have Europe on one screen. He might have whatever, China on a screen. So he's just looking all, he has it all memorized, what's where, and he's got alerts coming up and red flashing things going on. But you usually have these kind of things set up on your machine so that you can quickly see when something's happening. All right, any questions on non-US stocks? Obviously, a lot of opportunities there. You can make that your entire career just by picking one country and going. A good friend of mine, Warren, up in New York, they're actually moving to California, but he's fluent in Japanese, and he was USA's emerging market manager. And it's interesting managing emerging market mutual funds and international mutual funds. You don't come into work at 9 o'clock. Because what's the problem coming in at 9 a.m. in the United States? The markets have been open all night long. You know, Japan opens first. And so I used to get up during the crisis in 2008. I often got up in the middle of the night just to see what was going on in Japan. And I get up, okay, Japan's down 10%. Tomorrow's going to be a horrible day. That was my life in 2008, especially the last 3 months. Because you're just so stressed out. You want to go look, oh, Japan's up 5%. You gotta like, I can go back to sleep. Japan's down 10%. I might as well get up now. It's 2 a.m., but might as well get up. It's gonna be a horrible day tomorrow. So if you're an international manager, you might come in the middle of the night and leave at 10 a.m. the next morning because there's nothing for you to do. But it is challenging because there are non-US stock markets in our hemisphere in the same time zone. So, you know, how do you work all that out? It's tough being an international stock manager. You might end up moving to London, so you're kind of more in the middle of everyone. But yeah, I mean, that's the challenge of international markets. You can see down here at the bottom, here's Japan, here's China, and it's negative numbers. China is definitely dominates everything down here. Thailand's at the bottom. I understand Thailand being at the bottom. I don't understand Sri Lanka being at the top, but who knows? You see all this political turmoil and that their markets are doing great. Who knows? All right, alternatives. So we enter our last asset class. And this is where it gets a little bit, it depends on who you are, what you're going to classify as alternatives. So I include non-US bonds as an alternative. I don't include emerging market stocks as an alternative, but I do include non-US bonds as an alternative. It just depends on the investor. So the main driver here is 2 things. So when you're putting this on your exam answer, it's 2 things for alternatives. You buy them for diversification, and if it's a real asset like real estate or timber, you're also probably hoping for some inflation protection. So diversification, low correlation to other asset classes. So you saw in 2022, stock market dropped, bonds dropped, but oil was up. Commodities were up because of inflation. So they're the alternative of commodities. Those real assets helped you a great deal. So when we look at real assets, we look at alternatives, real assets is the major classification there. There's other things you can put in real assets, but that's the major one. And the biggest asset class in the world is real estate. It dominates all others. It's larger than stocks, it's larger than bonds, but we don't notice it because a lot of real estate is not publicly traded. Like your, residential real estate, that's owned by your individual people around the world. So that's not a traded asset.
I do with the mortgage-backed securities.
Mortgage-backed securities is a bond. But
isn't it still kind of like most people don't afford like their home outright? So it's
that's true. I mean, they own the home and the mortgage is the debt. So it's still they own 100%.
bank own the home until you pay off taxes.
No, I think Well, and technically it's non-recourse debt. So if the house price falls, you can hand the keys to the bank and you aren't really defaulting. You're just saying, hey, I can pay off the debt, I'll give you the keys. So from that standpoint, it's a little different. I mean, your exposure is to the value of the house, definitely. But yeah, I mean, you could debate that, but mortgages are going to go under the debt side, and the full value of the real estate, not X mortgage, but the full value is going to go on the real estate. If you think the mortgage should be subtracted out, then you could, that would probably reduce real estate significantly, right? There's probably 50-60% debt on real estate, but you could say that about stocks too, right? Stocks are pretty heavily levered as well. All right, so it has an expected return, who knows? And I'll show you why we don't know, but probably has a return expected between what you expect on stocks and what you expect on bonds. And it probably has a risk between stocks and bonds. We don't really know because we don't have daily market data on real estate. We just don't know what real estate is worth every single day. You don't know what your house, you can go out to Zillow, but how accurate is Zillow? It's not going to move up and down like the stock market. It's going to be pretty smooth. And so that's the problem. Real estate, we don't really know how volatile it is because of appraisal smoothing. A lot of real estate is an appraised value. That's not going to be nearly as volatile as what markets do. Now, our real estate, I'm only counting residential real estate. I'm excluding residential. So I'm only counting commercial real estate. I'm excluding residential. I used to say that's because almost all residential is not publicly traded. It's apparently people owning it, huh?
Could you just explain appraisal smoothing?
Appraisal smoothing means, and a good example, commercial real estate, there's an index for commercial real estate, just like there's a stock index. But stocks are traded all the time. The majority of the real estate indices are not traded. There's very little property traded. So most of the values in there is not a price for the real estate. It's someone's estimate what that real estate's worth. It's an appraisal. And appraisal is very, very different than the actual true market value of the house or a building. Yeah, and so when people give appraised values, they're much, much smoother than what you get if stuff is trading every single day. So I used to say we're only looking at commercial. The world has really, really changed. It's amazing, like firms like BlackRock are buying a lot of residential real estate now. Really, really bizarre. And so is residential real estate becoming an asset class? Who knows? You can't really, if it's BlackRock buying and it's not, but is BlackRock going to put that in the funds so you can actually have access to residential real estate? Who knows? Some cities are pretty upset because BlackRock's buying a lot of their real estate. And so they feel like, it's kind of like the Airbnb effect is like, why is BlackRock buying all these houses? We're going to have a bunch of people renting instead of owning. Would you rather be in a neighborhood with renters or owners? I don't really care, but some people say I'd rather have owners. It's true, an owner is probably going to take better care of a house than a renter. But I don't really care, but some people that would be a big deal. We don't want BlackRock buying up, 20 houses and then renting them out. We'd rather have people that are going to be there for 10, 20, 30 years. Who knows? It's kind of, you have to look at the statistics. On commercial real estate, we tend to break it up two ways, either by geography or by property type. Geography in the U.S., it's regions, Southwest, Northeast, Northwest, Midwest, those kind of things. And those regions do have economic differences. California versus Texas versus Florida can have differences. And then you have property type, hotel, office, retail, industrial, apartment, malls. Which one of these do you think is doing the best in that group? Doing the best. What's office doing? Yeah, office has had a problem, right? Post-COVID, people working from home. Also, office is struggling. Yeah, I don't know specifically industrial by far, because firms like Amazon and all these places with these big data centers, industrial is the place to be. It's just been a strong asset class. When I was at USAA, that was where their money on the real estate was. They were doing these build-to-suit industrial parks and where they were just making a fortune on those things. So office is probably the most struggled. Malls is, Any of y'all never been in a mall in this classroom? Is that possible? Never in your life? So when I was a kid, that's where we lived, but you guys, y'all don't do that at all. So that's certainly changed. Retail is not doing as badly as you might think, even though malls are not doing well. Lock and Terror is actually doing pretty well, I think. I don't think it's struggling too much. But we are doing more online shopping. So, we're seeing a lot of stores, but how much traffic is there? So it's hard to say on retail. Hotel, I think, is actually doing pretty decently well right now. It seems even after COVID, it seems to be doing okay. But each of these property types have very, very different types of risk, and they're very sensitive to different types of things. Hotel, you can change your rates every single night. Office, you have a 10-year lease. That almost looks more like a bond than it looks like real estate, because you got 10 years of this cash flow coming in. So everything, well, Andrew, you're an expert on real estate, right? Am I saying that right? But what are they saying in your real estate classes? Oh, really? Are these participating leases, like 5% of revenue, or?
No. It's based on square footage.
Yeah, it seems like retail is doing well, just because I see some of these blocks where it's like, I think they may be more office, where it's just like, they're not going to lease all that out. There's no way, but it seems to be all our place. You look at office in New York, that's obviously a very prime real estate area. How's that doing? More and more people want to work from home. There's a good article this week on The Economist. San Francisco's struggling horribly. And yet, because of AI, you're actually seeing a rebound in San Francisco in office space. So it's a very unique asset class. There's some local issues, there's global issues, there's all kinds of things going on. Now, is there a way we can get away from this appraisal smoothing? What if we put real estate into a daily traded stock fund and call it a REIT? Have y'all heard of REITs, real estate investment trust? So what if we created a mutual fund and just like bunch of real estate into it? Now we got daily prices. That's wonderful. Except for what? It no longer looks like real estate. Now it looks like a small cap stock. As far as its risk and its correlation, it looks more like a small cap stock. It doesn't look like real estate. When you make something liquid and make it daily traded, it doesn't look like its original asset class. There's an Economist article. I'll try to do that with private equity. We'll talk about a little bit about that. You really change the nature of real estate if you start daily trading it. It looks very, very, very different. Now, USA has some private REITs. Those are a little different. They're not traded on stock markets. They're REITs, but they're more like private funds. But if you have a REIT that's traded on a daily basis, it's going to look a lot more like a stock. Now, NAREIT, which is one of the major trade associations, they came to USA. Actually, it was an Associates came to USA. They were hired by NAREIT. And what they're trying to prove to us is that REITs had changed in their personality, and they're actually looking more like real estate and less like stocks. And we thought, wow, that's really interesting. And I looked at their numbers and I ran my own numbers and said, they're exactly right. That's true. For that one period of time they just did. If you did the period after they left, it all went back to where it was. So they had this one period of time where REITs looked very unique, very diversifying like real estate, and then it just completely disappeared. So it's tough. It's hard to get something illiquid like real estate and make it liquid without radically changing the nature of that asset class. So I do not consider REITs to be real estate. I consider that to be a small cap stock. It's going to have some of the nature of real estate, no question, but it's going to be a very volatile asset class. So I'm giving you some websites here. NACREIF used to be a great website, and then they required membership. I can't spell NACREIF. Sorry. How do you spell NACREIF? NCREIF. NCREIF. I just had an extra C in there. I just can't type. Forbidden, that's even worse. ncreif.org. Maybe that's my problem. I apologize if something really horrible comes up. I can't really type. There we go. The leading provider of investment performance indices for U.S. commercial properties. They used to provide their data for free, so you could actually get quarterly returns by property type. Now you got to pay money for that. When I was at USA, we had that for free. It was quarterly, not monthly, definitely not daily, quarterly. And then it was always most volatile in December because that's when everybody did their appraisals. So it changed a lot in December. But I don't think you can do that anymore. I haven't been in their site for a while. It looks a lot different. But they have a login, so you have to pay for it. But did they talk about NCREIF in your real estate classes? So they have a conference, artificial intelligence meets real estate. That's kind of interesting. And then NAREIT, I don't think I typed this correctly, but NAREIT and REIT.com. NAREIT.com, if I could type. So NAREIT is real estate, but specific to REITs. All right, REITs, it's real estate that's traded as a stock. There's a bunch of tax rules about it. It's still a small smidgen of the real estate market. Not that much real estate is traded like that. Investing in REITs, REIT data, so they provide some data and that kind of thing. But most of their REIT data that you can get off of Bloomberg, because these are publicly traded securities, it's pretty easy to get the data. And then, well, that is REIT.com. So NAREIT is REIT.com. So a lot of free stuff in there, and they don't require, I think you can get a lot of stuff for free without looking at it, but then it's easy to get anyway. So I don't consider REITs to be real estate. I consider it to be a stock that's just in the real estate market. And some firms just do REITs because of the tax advantages. So I don't know if y'all have heard of American Towers. That sound familiar? So they build towers for cell phones. Does that sound like real estate? They own a little piece of land with the towers, but that sounds like technology or telecom or something. But they're a REIT. Why? Because they like the tax. They used to not be a REIT, and now they're a REIT. So the stock people moved them from where they were as a kind of a tech company, and they moved them into a REIT. That's just because they like the tax rules for REITs.
Do they provide any like inflation protection?
You can do the analysis. I think it's the exact opposite. Why? Because REITs are, because of the tax law, they have to pay out a lot of their earnings. So they're high dividend funds. High dividend funds typically compete with bonds. So interest rates rise, their prices generally fall. So yeah, they tend, I know people like at USA and their inflation fund, they put REITs in there. I told them I thought that was a mistake, because when inflation rises, these things like utilities are high dividend paying stocks. They tend to have bad years when, and you can see that in my data. Here where I put it. Oh, here it is. So the last 12 months with interest rates rising, you can see utilities and REITs are both down. With high inflation, they're down. Why? Utilities is inflation protection, because inflation takes off, they can raise their rates. REITs are inflation protection because inflation rises, they can change their rates. But because they're very interest rate sensitive, when you have inflation, they tend to crash. Okay, any questions on real estate? Obviously, you could have your whole career doing real estate.
So why would you turn in if you're making the portfolio, what could you like benefit?
Why would a what?
How could you benefit?
Well, REITs are, it's just, to me, it's just another sector. Do you buy tech stocks, you buy utility stocks, you buy REITs. REITs is a sector in the S&P 500. It's the smallest one. It's a really itty bitty. They used to be part of financials with banks and insurance companies. They broke them out as their own category. To me, it's just a sector. So I don't consider tech stocks as an asset class. It's just a sector under asset classes. So I wouldn't do that. REITs are unique because they're tax-free. REITs don't pay tax. When you invest in them, you pay tax. on the dividends. And they don't, and so there's some unique tax requirements with REITs, but you as an investor, you pay actually more tax if you have a REIT because you don't get the dividends received deduction, but the REIT itself doesn't pay any tax. So they should be able to distribute more because they don't have to pay tax, but you have to pay more tax as the investor. So they're a unique asset. Not all real estate stocks are REITs. So there's REOCs, which is real estate operating companies. They're like REITs, but without being under the tax code. So, there's other things down there. And there are, to Nicholas's point, there are real estate investment trusts that are nothing but mortgages. I wouldn't buy those as a stock. I would buy that as a bond. But there are mortgage REITs. That probably shouldn't be in the stock market at all. They're going to act a lot more like a bond. So you got to be a little careful because tax law is a big driver for REITs, and you're buying something that is very unique. All right. Any questions on REITs? So I had a mutual fund that I inherited, but fortunately before I inherited it, it got fixed. But a few years before I inherited it, it was 25% US stocks, 25% international stocks, 25% gold, which is crazy, and 25% REITs. And the argument was, let's make it real diversified. We'll have gold to protect us from inflation. We'll have REITs. They consider the REITs to be real estate, not to be stocks. Essentially what they had was an incredibly ridiculously volatile mutual fund because the gold stocks were incredibly volatile because that's a sector, really, really small sector. The REIT stocks are extremely volatile because they're just a little sector. 50% of that portfolio was in gold stocks and REIT stocks. That fund just crashed horribly. I'm glad I inherited it after the crash because that would have been a horrible fund. So when I inherited, it was 70% US and non-US stocks and 30% bonds. And it was just a much easier fund to deal with. So I wouldn't put 25% of my portfolio on REIT stocks thinking I'm diversifying into real estate. If you want to buy real estate, go buy real estate. Unfortunately, you need like $100 million or $200 million to do that, but you can certainly do that. All right, timber, my favorite asset class on the alternatives. Timber, what is timber? Is it real estate? Is it commodities? What is it? And it's all of those things. It's both of those things. Real estate is both real estate and a commodity. Timber is a commodity, like gasoline, oil, oranges. It's a commodity, but it's also real estate. So you own a piece of land where you have trees and you sell those trees. So it's real estate specifically for growing trees, either for pulp, for paper, or for hardwood and softwood for construction. It provides historically some pretty decent returns, provides some incredible diversification because timber tends to be a very local market. It's really hard to ship trees to China. Trees weigh a lot. They don't ship very well. They tend to, sink your boat. It's expensive, huh?
When you say it has good returns, is it like growing or is it just like?
Well, I've had that in my notes for a while, so I haven't actually looked here recently. I probably should go look and see. This website here is a really good one, HTRG. Hancock, HTRG. See if I can remember it. What color do you think it's going to be when this website comes up? Green. That's what you would think, right? And yeah, all pretty and trees out in the country. Why don't they show them chopping all the trees down? And they don't even chop them down anymore. They just have this big machine that just grabs it and rips it out of the ground. Why don't they put that on their website? So this is a environmentally sensitive industry. They say they help the environment because they replant, they control, they do a lot of things. They say they're actually good for the environment, but they're going to be as green as they possibly can. They give you the argument for it. So let's see, Andrew, if they say it's for good returns, they would probably talk about that. They have, obviously, climate change is a big part of their website because that's going to be a big issue for them. This is one of the biggest timber firms out there. There are timber REITs as well. So you can actually buy a REIT that does timber, but that's not going to be timber. Timber is when you're actually buying trees in forest as an investor. You would go to them and say, hey, here's 50 million bucks, put it into your timber property, and we want to be an investor. It's an interesting asset class.
And you just invest in that the way you do with all these other platforms?
Well, they go around and visit, and it tends to be a lot like venture capital, where you don't just pick up the phone and buy it. You're going to sign a contract. You can say, hey, we're dedicated $100 million over the next year, and they'll make these cash calls. So it's a very illiquid asset class. It has good diversification. Sorry, I'm wrong chart. Good diversification, mainly because of the local issue. So what does Texas do in timber? Do we have any timber in Texas? If you ask your New York friends, does Texas have timber? What would they say? No, it's one big desert. What do you mean? A bunch of tumbleweed. No, Texas has massive timber. Texas is one of the biggest timber markets. We grow a lot of trees. So if you haven't been to East Texas, go to East Texas. Beautiful, beautiful trees everywhere, just gorgeous. Texas is a major timber producer. Try that next time you meet someone from New York and just, see if they believe you. But Texas is a major, in fact, there's a huge hurricane that went through Houston, destroyed a lot of timber in that hurricane. Major, major, major damage. So there are firms that do timber around the world. So Australia has a big timber, Europe has timber, China, around the world, there's a lot of timber places. So some of these companies are global companies, but you don't just show up in China and start buying lands, so it's difficult to go overseas. You do it pretty slowly, huh?
Can you talk about the stored on the stump?
Yeah, I'll talk about it. So what does store on the stump mean? So let's say you buy a barrel of oil and the oil prices are too low. So you say, wait, I'm just going to hold on to this barrel of oil until oil prices change. What happens to that barrel of oil while it's sitting in your backyard? It expires. I don't know if it expires, but worst case, it just sits there, right? If it gets worse, does oil kind of dissipate? I don't know. It degrades. Or if you buy a bushel of oranges, I don't like orange prices. I'm going to let them sit there. What happens? Not too good. You buy cattle and you don't like the price. You can feed them, but how far can you feed them? At some point, you've gone far enough. But what about timber? You don't like the price of timber. What do? You just let it keep growing. And what happens while you're waiting? It gets more valuable. So if you don't like the price of timber, you can just leave it in the tree and you have more tree. It's a very unique asset class where if you don't like the prices, you wait, and while you're waiting, you're getting more product. Pretty cool asset class. That's what store on the stump is. I like this asset. I'm tempted if I were in college, because I love the outdoors. So I'd be tempted to this asset class. My whole department was like, we had a timber guy come visit us, and they said, we need to go visit their properties. They want to go on a hunting expedition. I said, no, you can't do it just to go hunting. But they were asking this guy, because back then we're all wearing suits, and he came in a suit. He says, yeah, I almost never wear suits. I'm in blue jeans all day long. But so I'd be tempted, get my finance degree, go to A&M, get a forestry master's degree, and go do this for the rest of my life. I think it'd be a pretty cool career. You get paid a lot. You're outside a lot if you like the trees. If you have the expertise, I don't think timber is going away. I don't think we're going to stop using timber at some point. I think it's around for a long time. Wouldn't that be a pretty cool career? You'd be specializing. I don't know if A&M has a forestry degree, but I imagine they would. My downside is I'm terrible at science, so that might kill me right there. I don't know if I can handle the science of forestry, but you wouldn't get a master's in finance. You get a master's in forestry, you get that degree. If you did that, I think you'd be set for life with a really good degree. And you'd be visiting these places with a lot of trees. It'd be pretty interesting. I think they'd a cool degree. And you'd interview with a firm like Hancock, and just, they would hire you probably right out of A&M. I know A&M's a rival, but does UTSA have a forestry degree? Do you think? Maybe it does. I don't know. What department would that be in? Yeah, I don't know if we have a department like that. So it'd be a pretty good career. I think he'd be around for quite a while. I noticed it in Costa Rica. So we do micro lending in Costa Rica. We started a new restaurant in the middle of the jungle. You think that'd be a terrible place for a restaurant, but they're actually doing pretty decently. Right across the street from them, there is a timber ranch. They're growing pine trees. It looks so weird. It's like I'm in Costa Rica and then suddenly I'm in Bastrop, Texas. It's really bizarre because they don't have pine trees in Costa Rica. But for some reason, they grow faster in Costa Rica than they do in Texas. And so they've started a pine tree. My 2 trips ago was the first time. So it's been there for over a decade. 2 trips ago, probably last year, year before last, the first time I saw a truck with massive, massive trees on the back of it. So they're just now starting to harvest. So it can take 10, 20 years, but that's the investment. Now they're going to start reaping all the benefit. I don't know where they're selling those trees, maybe just in Costa Rica, who knows? But it's an interesting field. The trees actually grow in Costa Rica are really not good for timber. So they had to chop all those trees down and plant pine trees. So it just, to me, it looked, and it happened during the time I was there. So it went from being jungle to being this massive pine forest. So yeah, there's opportunities all over the place. The interesting with Costa Rica is one of the greenest countries there is as far as environmental stuff. In Costa Rica, they'll actually pay you money just to have land with trees on it. They pay you this environmental thing. So if you just have trees and you don't touch them, I don't know if the timber there actually gets that government subsidy of how many years, so it's interesting. I did the math and you could almost justify buying a piece of land in Costa Rica just for that subsidy and just let it sit there and collect your rent every month from the government. But they're struggling. I don't know if I was looking at Costa Rica's government debt and it's rated like single B. So they're not doing well. So maybe they won't be able to keep that up. All right, commodities. So you've got real estate, timber that's in between real estate and commodities, and you have commodities. Commodities are usually in 3 categories: energy, agriculture, and then metals. Energy is oil, natural gas, gasoline. Even the biofuels, that's the thing with Costa Rica, they're really heavy in the biofuels. I'm sorry? I don't know if nuclear is traded like that. But plutonium and those kind of things are, yeah, I'm not a commodity expert. I don't know what all is actually traded in these markets. So energy is maybe expanding. I don't know where alternatives are getting in there. Agriculture can be cattle, it can be coffee. We'll look at the list at FinViz. And then metals. Metals, we tend to break in between precious metals and then production metals. So copper is a production metal. It's very sensitive to the construction industry. Obviously, copper right now is used in electronic vehicles, so that's a big deal. It's amazing. Indonesia is like 50% of the nickel and copper. You're seeing certain countries that are really dominating these. Some metals are absolutely precious metals like gold. Some metals like silver are both precious metals and production. So metals can have some good characteristics. Let's look at FinViz. It gives a great list. So you just click on futures. Once the advertising goes away. Futures. So you have the markets, these are not commodities. And you have crude oil, WTI, and Brent. You notice how different those prices are. It's pretty amazing. Those used to be really close to each other, but because of storage issues and other things, they're really far off. Gasoline. Is that what you're paying at the pump? So obviously there's a markup at the pump. What is gas in San Antonio? $3. $3. I don't ever buy gasoline anymore, so I don't even pay attention. Heating oil, natural gas. Obviously, there's been some huge differences in prices there in the U.S. versus in Europe. And so we've been doing the liquefied natural gas, and then the Biden administration has been cutting that down. It's interesting what's going on with natural gas. Natural gas for the longest time, it was $4, $5, $6, and then it dropped down to $2, and it's gone lower. It's amazing with the Ukraine war going on, natural gas back below $2 again. It's pretty phenomenal. I think we've had a pretty mild winter, but ethanol, there's your kind of halfway biofuel where you have wheat. Then you get into agriculture, cocoa, cotton, orange juice, coffee, lumber, there's your timber, sugar, soybeans, soybean meal, corn, wheat, rough rice, oats, canola, feeder cattle, lean hogs, live cattle. We do a lot of live cattle in Costa Rica in our microlens. There's one lady, her name's China, one of our best microlending. We're like, have no doubt loaning her money here to pays back. What she does, she goes out and buys 5 really bad cows. They're just skinny as they can be. She gets them really cheap price. She brings them back to her farm. She feeds them. She sells 4 of them and pays off her debt. And she makes a cow every time. So she buys 5, sells 4 for the loan. She ends up with 1 cow. She's been doing that for some time very successfully. Her brother goes out. There's some people out in the area where she is who don't know how to handle cows. So he goes out and buys really cheap, skinny cows for a cheap price, brings them back to her. So I don't know how sensitive what she makes is to the world cattle market, though. I've kind of been trying to figure that out. We do a lot of coffee loans there. If coffee prices are high around the world, does that make them more profitable or not? So those are the kind of things, it's interesting. How much of these are local markets versus global markets? And then you have your metals, gold, silver, platinum, copper, palladium. And then the currencies are not in that category. So what, sorry, what did I just do? Okay. All right, so commodities are much more tradable today than they used to be. Now, it's not too hard. If you have an account, you can do commodity futures, so you can somewhat get into this market. But now we have mutual funds and exchange traded funds that do commodities. But you have to be really, really, really careful because the S&P one is 60% energy. If you buy theirs, it's going to be dominated by energy. Whereas the Dow Jones AIG one is only 31% energy. So when you buy an ETF that says commodities, you better check the allocation to energy to make sure you know what you're buying. I gave you some websites. It gets a little tough. One of these is, I'm having a tough time finding this one, but that one you can certainly find. So that's commodities. There's an Economist article on TIPS, the inflation-linked bond, and why they did so badly in 2022 when inflation was up. Exactly what we talked about in class here. Real interest rates were up, so they went down. So that I'm kind of wondering if oil is not a better inflation hedge than TIPS. It'd be a good analysis to do. It'd be a really good paper if you need a research paper just to see what does better in an inflationary environment. In those 70s, inflation was really high and oil did great in the 70s. 2022, oil did great, so you might see it's maybe the better protection. So yeah, you can get your hand, and not only that, you have ETFs that are just oil or just gold or whatever. So you can be very, very specific. I don't know if you can buy an ETF just on lean hogs, that would be interesting, or just on oranges or coffee, be interesting, but it's possible. All right, and then let's talk about something I know absolutely nothing about, and that's these other real assets. Artwork, collectibles, Bitcoins might fit in this category. I don't really know. Very, very specialized markets. I gave you a link to a pretty old article. It's a very unique area. You could make this your career. You specialize in this. You probably should have some background. I had one student in this class with a strong background on collectible coins. He knew coins backwards and forwards. I think it's more of a hobby for him, but he got real excited about finding coins. You can get really precise. Speaking of Costa Rica, there's a guy in Costa Rica, his collectible, you probably won't believe me, I'm not making this up. His collectible was beetles. Not beetles like the singing group, but the insect beetles. So I don't know if you knew there was a market for beetles, but he produces new versions of beetles. He takes 2 beetles that have never met from completely different groups, and he puts them together and he creates a beetle that has never existed before in the history world, and he sells it for like $500. He actually gave us one of the beetles to take back, but we weren't sure we could get it through customs. So
the same way.
Huh?
Snakes are the same way.
Snakes, really? Oh, that'd be even worse, but. No, his wife does butterflies, he does beetles. Really interesting. They know what they're doing. We were tempted to invest with him, but he refuses to share his information with anyone and he's getting up there in age. So if he goes, the whole thing's, we're like, if you mentor someone and teach them what you know, we might invest in your lab, but if not, we're not going to do that. But he's well known around the world with beetle, but that there's a beetle group of people that know that kind of stuff. So, you can get really specialized. I don't know much about this. This is a really old chart. Just shows you the kind of things you see in there, different types of art, stamps, coins, classic cars, whatever. So there's actually an index called the Passion Index. It's up 90%, but that's over several years. So that's not all that impressive. For the exam question on this one, we won't go through it all again, but I'm really into spacing and quizzing, just constantly checking comprehension. So, right. Y'all should tell me that like in the beginning, why that starts. So the intro, you do need to define what a stock is. So it's the ownership in the firm. You can certainly talk about the limited liability. So you can lose 100%, but no more, but you have all that upside. So it's really skewed positively. We usually say stocks are log normally distributed because you can't lose more than 100%. You definitely want to talk about the expected return. So did y'all put that formula into your answer? All right. And then you want to say that that's a function of expected economic return, which is a function of productivity, labor, and inflation. So that's the good introduction. If you understand that, you've got a good grasp of what stocks is. It really is all about earnings growth. That's what a stock investment is. You're betting on earnings growth. We were talking about NVIDIA earlier. NVIDIA's come up with earnings growth. Last week you saw Lyft jumping 30% because of an earnings release. So it is all about earnings growth. NVIDIA and Lyft, it was one quarter, but the market interpreted that has some impact for the whole future. So those are the keys there. And then you get into bucks. So if I were you on the exam, I would do it a little differently than I did with fixed income. If fixed income was define subclasses and strategy, here I would probably do subclasses, define strategy. If I were doing it, mainly because it's hard to say style is, and then here's the subcategories. It's easier to say style has to do with growth and value stocks. Growth stocks are this, value stocks are this. Capitalization has to do with large cap, mid cap, small cap. Large cap or this. So it makes more sense. You could probably get around with capitalization has to do with the size of the company. There's these different categories, but so for bucks, what was bucks? Beta. What are the subcategories? Yeah, beta, you can start with stocks versus bonds overall, and then you have cyclical and defensive stocks. So yeah, beta is a technical term we're going to use later in the class, but beta is also taking a life of its own. Just mean what exposure to the market do you have? And the more exposure you have to the stocks, you have more beta. The less you have the stocks, you have less beta. So beta is just your exposure to the stock market overall. And so yeah, cyclical defensive. And this one's pretty obvious on all of stocks. The strategy is all about economic expectations with one exception on the U. We'll get to that. Okay, so when do you want cyclical stocks? when you expect the economy to do well. And the best time to buy cyclical stocks is right after a major crash at the bottom. Once the economy starts doing well, that may be too late because you'll notice cyclical stocks, they don't wait for the economy to recover. They recover before. So I think I mentioned the leading economic indicators. So one of the leading economic indicators is the stock market. The stock market reacts positively before the economy does. So the stock market's actually a leading indicator. It's one of their leading economic indicators. So if you expect this economy to recover, you want to buy cyclical. If you're expecting the economy to weaken and go into recession, you would want defensive stocks. Here, the key is you're going to use a phrase within stocks on the tactical question. So if I tell you, hey, we're expecting a recession, you don't want to say, all right, we want to overweight defensive stocks. You want to say, hey, we want to underweight stocks, but within stocks, we want to overweight defensive. Everybody hear all of that? You might be under on defensive stocks, but relative to cyclical, you're going to be overweight defensive. All right. So within stocks. So overall, if I expect a recession, I want to reduce my stock allocation, and within stocks, I want to reduce cyclical and increase defensive. Any questions on that? You'll be saying within stocks on the exam a few times. So that's an important concept. All right. What's the C? Capitalization. So there are your subcategories: large cap, mid cap, small cap, micro. You can't get away with just large cap, mid cap, small cap if you like it. I don't think there's indices or exchange traded funds for micro cap.
Explain a little bit more about what you mean by within stocks.
So if your boss says we're expecting a recession, you don't say we want to overweight defensive stocks. So a good example might be your normal is 25% cyclical, 25% defensive, and so you're 50% stocks. If you're expecting recession, you might say, let's reduce stocks to 40%. So that cyclical is say, or let's go even further. Let's reduce stocks to 30%. So cyclical is 20%. I'm sorry. Cyclical is 10%. And defensive is 20%. Now, did you increase defensive or reduce for defensive? What was defensive before? What is it now? So you actually reduced it. But relative to cyclical, what did you do? You actually, it's higher. So within stocks, I'm going to lean more toward defensive. Before I was 50-50, right? Now I'm 2/3 defensive, 1/3 cyclical within stocks. All right. So if I look at defensive as a percentage of stocks, it's now 67%. But my overall defensive is 20 instead of 25. All right. Does that make sense, Jalen? All right. So within stocks, I prefer defensive, but overall, I'm going to reduce my stock allocation. Exact same thing here. So let's leave out macro because it's a little much. If you're expecting a strong economy, where would you want to be? Larger cap or smaller cap? Smaller cap generally does a lot better. If you're expecting a recession, what are you going to say? You're going to reduce stocks overall, but within stocks, you have a preference for large cap stocks. All right. So that within stocks becomes important anytime you defensive. If you're not if you're not expecting a recession, a strong economy, you can just say overweight small cap. I mean, that's going to be working out pretty well. Sorry, I'm cold. All right, what about the S? Yes, some students do structure. It's not structure. That structure is bonds. Here for stocks, it's style. What are your categories there? Growth, Value. If you're expecting a recession, you want growth stocks. If you're expecting a recession and interest rates to fall, growth stocks is generally, not always. Remember, GMO right now disagrees with that, but growth. So remember, value stocks are lower quality companies. Don't think of value as high quality. Value stocks are low quality companies. They generally don't do well in a recession. And then the U. So we're essentially talking about non-U.S. stocks. There you have U.S. developed, emerging, and frontier. You could kind of leave frontier out. There may be, I should have checked, there may be ETFs with frontier markets, but I doubt it. You look at frontier market, you're talking some scary stuff. Although I mentioned Pakistan and Sri Lanka, as horrible as those countries are having political problems right now, their stock markets are up 70-80% for some reason. I can't explain that. Guess how much money I have in Sri Lanka right now? I guess it's zero. I wouldn't even Sri Lanka. Just listening what's going on in that country. Y'all hear what they did? It's crazy. They decided to go green and really work on the environment. Ended up starving their people by doing some really incredible things. So anyways, so I don't know what frontier markets, I wish I were in them if those two countries are doing so well, but definitely the first three are very common. So here the thing is, if I expect a strong economy, well, that doesn't help you. So here we're talking two things. This is really important. Two things here. The relative economic growth. So obviously, if you think Europe's going to do better economically than the U.S., you want to be in Europe. If you think emerging countries are going to do worse than the U.S., you want to be in U.S. and not emerging. So it's relative. What else would be relative? There's two things here. Relative economics and relative currencies. All right. On the exam question two, I don't throw any curves there. If I say, hey, I think Japan's going to do great, I also think the yen's going to do well. I don't mix them up, so I'm not going to make you have to decide, but you can have those decisions. Currencies get really tricky because if the currency's weak, that makes that country's exports cheaper, which helps the economy. So the economy can be weak, their currency's weak, but the weak currency actually helps the economy. So it can get really circular and real complicated. On the exam, I don't do that, but just realize when you bring currencies in the mix, things get really messy. All right. So this is the skeleton. Obviously, there's a lot more you can put into your answer, but there's a skeleton. But you notice on bucks, it's almost entirely about economic expectations, with the exception when you're outside the U.S., then you have to have some consideration for currencies. Obviously, U.S. dollar has been strong here recently. The yen's been really weak here recently, but usually people who do currencies are PhDs in economics. It's a pretty advanced field. Any questions on all of that?
So we're supposed to define bucks, right? Like beta, we define it. But we also define as cyclical and defensive stocks.
Well, that's what I'm saying is on beta, you can kind of define it, but you can define it really by defining the two groups. Beta has to do with cyclical versus defensive stocks. Cyclical stocks are, so that becomes your definition. You could say beta has to do with what your exposure to economic cycles. And we break that into two groups. There's different ways you can do it. I can't remember how I did it in the notes, but yeah. On bonds, you definitely start definition of duration and then subcategories. Here, you can kind of mix the definition and the subcategories. Other questions? All right. So let's finish up alternatives. So we talked about real estate, timber, and commodities. Those are all real assets. And then we did the specialized ones, which I don't really, those are Very, very specialized artwork, coins and stamps. The other category I'm going to throw in is venture capital. That is not a real asset. Venture capital is essentially equity, it's stocks, but that aren't publicly traded. And I shouldn't have said venture capital. I should have said private equity. Private equity is the bigger category. So private equity is all firms that aren't publicly traded. Venture capital is private firms that are starting up, beginning firms. So I really should have said private equity, but venture capital, here I say venture capital and private equity. It's the way to buy even small companies is not correct. Because if you remember, Dell Computer went private a few years ago. That is not a small company. That's a massive company, but they went private. Burger King went private a few years ago. They've come out again. I can't remember the last time I ate at a Burger King. It's been like 20 years, but I don't know how they're doing, but they went private and come back to public. So it doesn't have to be small companies, but we generally think of them as small startup kind of companies. Have y'all heard the phrase unicorn? So what is a unicorn? Yeah, it's essentially a venture capitalist firm that's over $1 billion, just has risen up in value really quick. So very specialized area of finance. You'll hear this term J curve, and I definitely noticed it at USAA. J curve is usually, so the way it works in practice, venture capital, I inherited this portfolio from USAA. It was really small at USAA. I think our max was maybe 400 million bucks. So we hardly did any venture capital. But I inherited the portfolio, wasn't being monitored well. The woman who was following it, she had it all in the shoebox and just handed me the shoebox with all the data. I put it into Excel at least. But the way it works is you have these partnerships. So you sign up for a venture capital firm and you sign up for 10 years and you say, hey, we're signing up for 15 million bucks. And they say, okay, we got USAA down for 50 million bucks. They may ask for $10 million next week. And in a month from now, they ask for another 15 million. And they do these cash calls. We send them the money. They invest in these small companies as they find them. So that's the bottom part of the J curve. We're funding those firms. All it is cash outflows. And then slowly over time, these firms start developing and making money. And then they do what? What do you hope they do? IPO, hope they go public. And that's when you get stocks. And then we had a lot of those. We had some pretty exciting names that went public in our portfolios. And my responsibility was to sell those stocks. And I don't have time to analyze them. So my question is just, when do we sell them? So I did a big analysis. So I'd sell them a week later, 2 weeks later, those kind of things, try to figure out when should I sell this stock. So that's a J curve. So it can take 10 years. Usually around years 5, 6, and 7, you start seeing more IPOs. And then in year 10, you got a bunch of these kind of just sitting there, not doing anything. It's like, are they going to go anywhere? Do you write them off? Do you keep them? You have that problem at the end of 10 years.
So you said that it doesn't really just apply for small, it also applies for large companies.
There are huge private equity. They're pretty. What happens is you have a firm like Dell Computer. So Michael Dell, he wanted to fix his company, but he wanted to do it in private. He didn't want the markets. When you're in the stock market, you're constantly being beat up by your shareholders, by market prices. Michael Dell said, you know what, I'm going to fix my company. I'm going to do it without anybody watching. So he took it private, fixed everything, and he went public again. Burger King, I can't remember who did the Burger King thing, but yeah, so you can have, those are, Dell's a really big company. I don't think Burger King's all that big, but yeah,
the actual buying happens. So I think probably
well, you got a leveraged buyout where, just management gets together and takes on a lot of debt and buys all the stock back from all the stockholders. Taking a firm private, I mean, it's essentially you're just buying off all the stock and shutting it down. And now it's just owned by management or whoever, some venture capital firm. Yeah, it's its own world. There's certain universities, if you want to do this, you're not going to go from UTSA into private equity. We do have some private equity students in a few cities. There's one of our students is in Austin. Austin is a venture capital city. But whom do they hire? UT Austin. Boston's a venture capital firm. Whom do they hire? Harvard, MIT, right? So there's venture capital tends to be in cities, San Francisco, obviously. They tend to have the universities that they want to go after. So if you want to do venture capital, you're probably not going to go from UTSA to it. You're probably going to have to get a master's or start somewhere else and move over. It's just not easy. It's not there's anything wrong with UTSA. It's just private equity doesn't think of UTSA. They have their schools and that's where they go. We actually went to a Harvard conference on private equity, and that's just what they're known for. That's what they do. So yeah, after 5 years or so, they start going public. After 10 years, that's when you have just these stragglers at the end that just, you don't know what they're going to do. We had one venture capital, everything went IPO or went out of business, and we had this one company and it just would not go away. We had to decide what to do with it. The venture capital said, well, it could work out. If it does, it's gonna be great, but probably, so we just wrote it off to zero and we said, hey, if it works out, that's all gravy. If it doesn't work out, then, so those are frustrating because they just stay around forever and ever and ever.
Lose all that money?
Huh?
Lose all that money?
It wasn't very much. That one was like, we had it on our books for like $300,000. So my decision was we could have sold it to him for like 100,000 or something. Or my decision was, well, let's just keep it at my work, and I don't even know what it did. And we wrote it off. I told the accountants, just write it off to zero, and if something happens, we get it. If not, so they're a bit of a tedious thing to do because it's very manual. You don't get market data. You get quarterly reports, which is pretty bad, and your quarterly reports is someone's estimate what these firms are worth, which that's just guessing. So you don't have a lot of confidence. But when they start going IPO, that's when you figure out what you have. So we had some pretty big firms. We had Medtronics, which is a massive healthcare equipment firm. We had Charles Rivers. So we had some names that came out that were pretty impressive. But overall, this portfolio at USA essentially made the exact same thing we would have made if we just invested in small cap public companies. So it wasn't a great return. But some firms like Harvard, some, especially big endowments, they do a lot of private equity. I think HEB does quite a bit in some of their retirement plans. It's a little bit different world. So I found an article in the Last Economist, very similar to what we talked about with REITs. So anybody know who MSCI is? The MS, Morgan Stanley, CI is capital indices. So this is not Morgan Stanley. This used to be Morgan Stanley, and they spun it off. It's their capital indices. How do you make money from capital indices? Well, you sell your indices like EFA. They develop EFA. And if you want to do a mutual fund that's based on EFA, you have to pay them money to do that. And so MSCI does that. And they're looking at trying to do a private market kind of ETF. So he's betting that MSCI's indices can penetrate the opaque world of private finance, private equity, 12 trillion plus in assets, private equity, private credit, private venture capital, real estate. Real estate is a private market. Infrastructure. We haven't talked much about infrastructure. So infrastructure is another alternative asset. Y'all know what infrastructure is? How would you invest in infrastructure? Well, how do you make money on bridges? So you have to have a cash flow. What cash flow you have on infrastructure? If you go to Houston, you don't notice it in San Antonio. Toll roads. You can buy a toll road, right? So infrastructure that has a cash flow, you can invest in this. So infrastructure has been a big one for some people, especially here recently. But we're mainly talking about private equity and venture capital. So MSCI spun off of Morgan Stanley in 2007, is a $45 billion company. It has two main revenue sources. It has 280,000 indices around the world. So can they do this? The second revenue stream is enabling investment managers to create products such as exchange traded funds. We'll talk about those. So how do you do this? How do you create an index? So are they going to actually create an exchange traded fund of this private equity? Or are they simply going to create an index so people with private equity can see if they're beating the market or not? So it looks like they're doing more of the second, but that's tricky because the data it's not public. So it's really hard to get the data. So they're trying to be in the benchmark business. But if they do that, could they use that to create ETFs? Private assets do not trade with anything like frequency. We talked about that with REITs, right? Real estate doesn't trade every day, but if you put real estate in a public traded security like a REIT, yeah, now you have real estate in a publicly traded, but it changes the entire nature of the investment. And I think that's what they're going to find here. Lack of liquidity, it's going to be tough. He believes that some parts of this can be like private, and the private loans is a lot easier. Why? Because private loans are a lot easier to value than private equity. Private equity is anyone's guess, plus or minus, 80%. But on private loans, you're going to be pretty close on what everybody believes. So credit makes sense. That's a lot easier one. If we could ETF, they've ETF to Bitcoin. It hasn't done all that well, but imagine what we could do with other things. Yeah, possibly. And I don't know, do you trust someone that called Mr. Fink has become an advocate of this? The idea that financial assets and the owners can be registered on the blockchain like Ledger. And so who knows? Is the world really changing? I don't know, but private equity is usually almost always an alternative asset. With a firm like Harvard or Yale, it can be a massive allocation for them, 20-30% of their portfolio. That's kind of their thing is let's do stuff that no one knows what we're doing. It's real quiet. We do have 2 alums. One's up in New York. No, he moved from New York. He got mad at me because I invited people to dinner in New York. He's like, I'm not here anymore. So I don't remember what he said he's in. He's doing a firm where they want to do private equity, but do it with really small companies. And I think he's kind of a tough time raising capital. I don't know how he's doing because he's going to be doing not $10 million deals, but $500,000 deals. That's going to be a tough business. Then we have another one in Colorado, and they're doing, I want to guess, they're doing private equity for cannabis. Not that I'm endorsing that, but that's their thing. He talked to the Investment Society a few years ago, a really interesting speaker, really kind of fascinating. They weren't sure what COVID was going to do to them, and COVID actually did really well. So, you can figure that out. But interesting, they're doing private equities, but specific to one little thing, which is a big deal because cannabis is not legal everywhere. And so you got to worry about how banks are going to treat you and how you're going to handle cross lines and all those kind of things. So it's an interesting, but when you specialize like that, and if that business takes off, now you got a huge advantage because you've got this knowledge base no one else has. So you can really specialize there. If you're interested in venture capital, I'd recommend you get a master's at one of those key schools that hires in that area. Austin's primarily a kind of a tech hub. So, and maybe some financial tech hub. What else could be alternatives? Are hedge funds alternatives? I don't consider hedge funds to be alternatives. I consider them to be other ways to do all the other markets. There's some hedge funds that are essentially equity hedge funds or bond hedge funds. So I consider hedge funds more an alpha play. They're your strategy to beat the market, but not a completely separate market. The hedge funds I did, they were kind of pure alpha plays. A lot of them are long, short. You might want to look up key hedge fund strategies like market neutral, global macro, managed futures. There's some pretty common ones that you'll see a lot and what they're all about. But to me, they don't sound like a separate asset class. They're kind of how you're going to. If you want your stocks to beat the market, you'll put some hedge funds in there to try to give it some juice and make it perform a little better. Derivatives, I don't consider those alternatives. We're going to talk about derivatives. Derivatives are just another way to get into markets. You can buy a Fidelity mutual fund in the S&P 500, or you can do futures in the S&P 500. You're essentially doing the exact same thing. So, currencies could be an alternative asset class. That's where I talk about currency overlay, where you have someone manage just your currencies. That's not too common. We did that at USAA, but it's not that common. I only did it oh, it was a really small portfolio. I don't even think it was $100 million. It was USAS business in Europe, and we had to have $100 million portfolio in Europe. And the bond guys came to me and says, we don't like even getting up at 2 a.m. to watch the European markets. And so I said, why don't we just hire a manager over there? So that's what we did. We hired a manager over there, and then I hired a manager to manage the currencies. So possibly. The problem with currencies is they don't have a cash flow. It's all a relative. It's if the yen is up, what does that also mean? The dollar's down. It's not like, wow, the yen and the dollar are both doing great. It's like, well, no, I mean, every currency can't do great. Every stock in the world can do great, but every currency can't do great, right? It's a zero-sum game. If the yen is up, that means the dollar is down. So currencies are a very special thing. You don't do the present value of a currency. There's no cash flow. There's no cap-in model to do that. So they're pretty unique. So here's some common hedge fund: long, short, market neutral, global macro. We did a lot of global macro. So yeah. Hedge fund, you should have some familiarity with them, but we're not going to cover them in this class. So infrastructure, I didn't put that in there. I would consider infrastructure to be an alternative asset class. Bitcoins, I don't know. I can't figure Bitcoins out. I don't think it's much different than currencies because there's really no practical way to value a Bitcoin and figure out if it's expensive or cheap. So Bitcoins are a little tough. Can y'all think of anything else that would be an alternative? What else could someone buy that would be an alternative? Can't think of any other categories. Yeah, if you see some, you could probably important alternative asset classes. See what they say. What are the different? They say hedge funds. I don't believe it. Private equity, private credit. That was a course. They're not even going to tell us. Hedge funds, I don't consider that. Yeah, I don't know if that's a good one. So, yeah, I don't know. 5 asset claims explains alternative asset classes, hedge funds, private equity. They're not even mentioning real assets. So Fidelity has alternative asset classes. A lot of times you'll find commodities in there. That's pretty common. Fidelity or Vanguard, they'll put commodities, and that's kind of about it. It's tough to put a hedge fund into a mutual fund. We did that at USA, but it's really tough. Our lawyers went crazy on that one. It's tough to put a hedge fund into a publicly traded mutual fund. Top 10 alternative investments, if I can actually find that, but nothing's coming up. Art, sports, memorabilia, that's those special classes we're talking about. Yeah, shoes, that's not what those are all the same category. So it's anything else you can think of, but I think we've covered the major ones. All right, so we're going to radically shift gears here and talk about the second question for exam 1. So you should have everything you need for the first question, and you should have your answer essentially in place, as well as working on your paper. But let's talk about the second question. The nice thing about the second question is there's no new information from the first question. The first question is outlining everything we've talked about. The second question is taking that and applying it. So you remember the strategy part of exam question 1. This is the strategy part. What do you do? All right. So question 1, in your own words, don't do any copying and pasting. Well organized, logical, professional style rather than student's perspective. It should stand on its own. So don't write me a paper, write a paper that someone else could read and know what you're talking about. All right. They shouldn't look at the paper and say, what are you talking about? You just make it clear. You can bring in extra material, definitely. So that's question 1. What about question 2? So here's question 2. I'm going to give you a scenario. I haven't written it yet, but I'm going to give you a scenario. I'm going to give you a list of asset classes, and you're going to tell me where you want to overweight or underweight. So what does overweight mean? If you normally allocate 40%, what would overweight be? 50%. So overweight means you like it. I've had some students didn't know what overweight and underweight meant. So overweight means you like it. You want more of that. Underweight means you don't like it. You want to underweight it. Now I'm going to get a list of asset classes, but there's one asset class I'm not going to give you, and that's stocks versus bonds. You just have to know to talk about that one. If I'm expecting a really strong economy, I'm going to overweight stocks, underweight bonds. All right. So it's a pretty easy one. So that one's all related to economy. Then bonds, you're not going to have the entire DC cuts I, but we will have duration. On duration, I say you expect interest rates to rise. You're going to prefer the shorter stuff, shorter term to the longer term stuff. Pretty straightforward. Convexity, if I expect interest rates to be volatile, you don't want those mortgage-backed securities. You want stuff with high positive convexity. And in quality, if I expect a strong economy, then you can buy those high yield bonds. You can buy those lower quality bonds. If I'm expecting recession, that's when you're going to move to treasuries. Taxes, that's the only math on the first exam. And we'll work some examples of that. If I say anything about inflation, you might like tips, even though tips didn't work in 2022. So, but for our classes, we'll say, hey, if you're expecting inflation, tips might be a place to go. Structure and US versus non-US, we're not going to do on the second question. Structure is really hard to put into a question like this. And US versus non-US, so that's really not an asset class anyway. We're going to move that to alternatives. All right. So on your exam, well, let's talk about stocks a bit. On stocks, it's pretty straightforward. It's all about the economy. On beta, strong economy, you can buy cyclical stocks. Weak economy, buy defensive. Capitalization, strong economy, small cap, weak economy, more preference for larger cap. Style, strong economy, value can work really well. Weak economy, growth is probably going to do better. And then US versus non-US, it's their economies relative to each other and their currencies. All right. And in alternatives, remember, real assets can help you with inflation. So if I say anything about inflation, you may want some real estate, you may want some commodities. If your boss says something about, hey, we need some diversification in this portfolio, alternatives, not a bad way to do that. And then any specific issues I bring up. If your boss says, hey, I think real estate's really overpriced right now, then you probably don't want real estate. All right. So in your answer, you're going to have at least 18 things in your answer. Let's see where those 18 things are. All right. One is stocks versus bonds overall, and that's going to have to do with the quality of the economy. All right, there's one. All right, we're going to do this a bunch of times. Treasuries, I'm going to have two things on treasuries: duration and quality. If you expect a recession, do you want treasuries or not?
Yes.
Yes, and what kind of treasuries? Short-term or long-term? Long-term treasuries. You expect a recession, long-term treasuries are a wonderful place to be. They were up like 60% in 2008. They're a wonderful asset class. But you got to talk about two things. Some students get 50% credit because I say, hey, we're expecting a recession with rates falling. And they say, I want to overweight treasuries. I don't know why you want to overweight them. Do you want to overweight them because they're high quality? Or do you want to overweight them because they're long duration? And your answer is yes, both reasons. So what do you have to do on your exam? You have to say both reasons. So you're going to say, hey, I want treasuries first because they're long-term treasuries. I expect rates to fall. Secondly, I want treasury because they're high quality and I'm expecting a recession. Everybody catch that? So if you just say, I want treasuries because I'm expecting a recession, you get 1 out of 2 points. If you don't say anything about rates falling and you like the long-term, all right? So that we're up to 3. Tips, if I say something about inflation, then you say, hey, I think tips make sense because I'm expecting inflation. So there's 4. Mortgage-backed securities, all about that convexity. I'm expecting volatile rates. You don't want mortgage-backed securities. So what are we up to now? 5, right? 1, 2, 3, 4, 5. Municipal bonds, look at that. There's 3 things on the municipal bonds. This is where students probably lose most of their points. Municipal bonds can be short-term or long-term. corporate bonds can be short-term or long-term. You can talk about them together. Because I'm not going to give you short-term municipals and long-term corporates. They're going to be the same. So duration is going to be the same. I'm not going to give you high-quality municipals and low-quality corporates. They're going to be the same quality. The only difference is going to be on the tax. So municipal bonds, corporate bonds, they have a duration. If they're short-term, that might be good if rates are rising. They're going to have a quality. If they're high quality, you're expecting a recession, that can be good. And then you have to talk about the tax fee. So there's three things there. If you only get one of the three, you lose 2 out of 3 points. So where are we now? 1, 2, 3, 4, 5, 6, 7, 8. High yield is easy. You're expecting a recession. What are you going to do with high yield bonds? You want high yield bonds if you're expecting a recession? No. A lot of students say, I'm expecting rates to rise. I don't want high yield. Remember, high yield has nothing to do with duration. I've never met a high yield manager that talked about the duration. High yield is, man, if you expect a strong economy, they're going to do great. If you're expecting recession, they're going to sell off. It has nothing to do with duration. What I find is a lot of students think if I say something that sounds intelligent, I'll get credit. But no, if you say, hey, I'm avoiding high yield because rates are rising, that's not a good answer. No one in a high yield world would understand that question. So high yield's all about the economy, right? Large cap, there's there's 2 things, but there's 3 things I can give you. I'll give you 2 of the 3 things. So this is really, really important. I'm not going to give you large cap stocks. I'm probably going to give you large cap cyclical stocks, or large cap low beta stocks, or large cap growth stocks. There's going to be 2 things there, and you got to talk about those 2 things. All right. So if I give you large cap growth stocks, that might be a good place to be if you're expecting a recession. But why? Number 1, they're large cap. Large cap do well in a recession. Number 2, they're growth stocks. Everybody seen that? All right. So there's that combination. There's 2 things, 2 there. There's not 3. There's 2, but I'll give you a couple. Small cap or mid cap. I'll give you one of the 2, and that's the exact same thing. So I might give you large cap growth or small cap value. If you're expecting a strong economy, which would you prefer? Small cap value. Why? Because they're what? Small cap that do well in a strong economy, and they're value stocks that do well in a strong economy. Okay. So I don't know where we're up to now, but 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. We're up to 13 things so far. We're going to do so many examples, you'll be comfortable. And guess what? Team question we're going to have not too long. You're going to have this question from last semester on exam 1, question 2. Your team will do it. Developed markets, it's relative quality. Which economy is doing well? And then developed markets, that's where you talk about currencies. All right. Emerging markets, I'll just essentially tell you. So your boss says, hey, I think emerging markets are going to do really well. And then maybe you want to over allocate to emerging markets. You don't need to talk about currencies on the emerging markets because it gets really, really tricky. You look at Argentina right now, they're tying their currencies to the US dollar. It gets a little tricky. The other tricky thing with the emerging countries is a lot of them are very commodity based. And commodity based countries are very sensitive to the US dollar. And it's a really, really difficult thing to talk about. So don't talk about currencies on the emerging markets. Leave that with developed markets. And then under alternatives, I usually have at least 2 things under alternatives. So if we go back and count this, you got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. There's going to be 18 bullets on your answer for this exam. And we'll practice it and practice it and practice it. All right. So you may be confused now, but you'll see when we look at an example.
You're saying in the end, you get a little bit supposed to go for?
Yeah, you should have 18 bullets in your answer. Yeah.
Are we writing this down in class?
Yeah, it's 30-minute question. It would be in class. After 30 minutes, I'll collect them and we're going to have class afterwards. So yeah, it's beginning of class, 30 minutes. You have to stop. So don't be late to that class because it would be a disaster. Time can be an issue. We used to do the entire exam in class, including question one that you're doing open book. Now you speak closed book, and we did this question afterwards.
Oh, just this part is 30 minutes.
Yeah, this part is 30 minutes. You're gonna submit question one on Canvas as an essay, right?
Oh.
All right. All right. So that's why I say you're already writing question one. Not for question two. For question two is completely closed notes. Question one, you're writing open notes before the exam, and you're submitting it on at the exam. Just like I can hear Marcus, just like what?
I was just trying to like.
Everybody, shh, I can't hear Marcus. I'm hard of hearing.
Just to confirm, like, we're gonna do the long essay question on Canvas, and then we're gonna do the tactical.
Yeah, long questions, open book. You're gonna submit it as a Word document on Canvas. It's due 4 o'clock the day of the exam.
Okay.
And then you're gonna do this second question in class for 30 minutes, closed book, no notes. All right, everybody getting it?
Six questions still essay type,
We're gonna do so many practices, you'll get it. It's gonna be confusing right now, but it won't be confusing by the time you get to it. But how many bullets will be on your answer for question two? 18, all right. 2/3 question one, 1/3 question two. Most students do better on question one than two. I have students get 80% on one and 12% on two. That's not uncommon.
Yeah.
I've had some that get 70 on one and 80 on two, but that's pretty rare. That's the entire exam. Question one is the long essay. Question two is the tactical. Yeah. All right. Y'all can't hear. I'm sorry. I'm 61 years old. I can't hear. Alex. You get the questions. You already have that one. Yeah, I mean, it's pages, whatever. It's everything we've been doing. What's the portfolio? The 3 questions, the asset classes. That's your question. You already have that. I mean, I can show you the question, but that's what it is. All right, let's look at some tactical ones. This first one's not a good one because it doesn't have all the pieces, but just to get started. So your boss provides you, this one's too short, but your boss provided with this forecast. She believes the recent good economic numbers are genuine. She expects surprises on the positive side. So what are we looking for economic here? Does it sound like a good economic forecast or negative? Sounds pretty positive. What are you thinking on high yield right now? Overweight. What about small cap value stocks? Yeah, I like small cap value stocks here. Yeah. What about long treasuries? No. All right. So you're already seeing it's gonna be pretty straightforward. Higher economic growth. Inflation should remain well contained. What do you think about tips?
You don't need to worry about.
Don't need tips. Commodities, not such a strong argument, maybe. Emerging countries should see very strong economic growth. What do you think about emerging countries? That one's a gimme, isn't it? Hey, they think that's going to be due. While developed countries, especially Europe, should continue to stay very weak. Pretty obvious. What are you going to do with developed markets? Europe is probably 50% of developed markets, so you can avoid that. U.S. dollar is going to strengthen. So you don't like developed markets. Why? Weaker economies and weaker currencies. 2 reasons. All right. We should expect some volatile periods. Now, don't overinterpret the word volatile. If you see the word volatile, that doesn't mean avoid mortgage backs. When do you avoid mortgage backs? Volatile interest rates. Is that volatile interest rates? That's volatility. It can be volatile economies, volatile currencies, volatile stock markets. So you avoid mortgage backs when you have expected volatile interest rates. All right. Just because you see the word volatile. That's why I'm trying to get used to this class in previous classes. Other classes with multiple choice, it's all about matching. No comprehension is just matching. I see this word, I pick this one. That's not the case here. You see the word volatile, doesn't mean your brain's, oh, I underweight mortgage base. That's not it. You got to look and see what is volatile.
So what should you think when you see the word volatile?
Well, the word volatile, it just depends on the context. So here, the only reason they're saying that is they want some diversification. So you have to see why are they saying that. Diversification implies maybe some alternative investments, maybe some real assets, maybe some private equity to try to get away from that noise. And then the marginal tax rate, that's where the munis versus corporates. But remember on munis, they're going to be the same quality, the same duration. So you're just trying to pick quality and duration, and then you got to pick, well, do I want more munis or corporates? That's where the tax rate comes in. You'll use that one equation. All right. So you're going to move down in quality. You're going to buy lower quality stuff. Why? Because the high yields going to do great. Small cap value. Remember, small cap tends to be a little more sensitive to the economy, but value, especially these weaker companies, they're going to do great because they probably got beat down in the economy coming into this forecast, and this is a great time to buy them back. You want to shorten duration because interest rates are going to rise. So that one's pretty straightforward, shorten duration. You prefer U.S. and emerging markets over developed market stocks. All right, so there's one simple example. You're starting to see there's not that many pieces. Strong economy or weak economy, that's going to answer probably 60% of it. Rates rising or rates falling, that's going to be important. Volatile rates or no volatile rates, that's important for one. Inflation or no inflation. There's only 4 or 5 things that I got to give you, and you got to decide how to get those 18 pieces. But those 18 pieces isn't 18 different things. You're talking about the economy and over 50% of them. All right, here's one. Well, this is probably the same thing. So I give you these asset classes, and you give me the bullets underneath. And I don't highlight them in red and green. That's what you've got to figure out, overweight, underweight. So long U.S. Treasuries, notice how many bullets? How many bullets is that? That's not one bullet, is it? What if you do one thing? What if you say, hey, I want to be underweight Treasuries because rates are rising? What do you get? You get 50%. What else is Treasuries? They're high quality, right? So if I'm expecting the strong economy with rates rising, I want an underweight Treasury. Why? Rates are rising. I want a shortened duration. Don't need high quality because of the strong economy. All right. Medium quality, short-term munis. Medium quality, that sounds okay to me. If you have a strong economy, they're probably going to do pretty well. Short-term sounds good, right? Because rates are rising. And they have a current yield of 2.6%. Remember the formula, 2.6% divided by 1 minus the marginal tax rate. That's 371. That's a lot higher than corporate bonds. So you're going to have 3 bullets. You're going to combine munis and corporates under one. So the medium quality, that's good. That gives us some exposure to those spread products. That's good. And we like the short term because rates are rising. And then we prefer munis over corporates because of the effective tax or the tax adjusted yield. Stocks overall, yeah, we like stocks versus bonds because we have a strong economy. That's the one I don't give you, so you have to just talk about that one. What about large cap, low beta? So we prefer stocks overall, but within stocks, we prefer small cap, we prefer cyclical, we prefer value. So within stocks, we're probably not going to like large cap, low beta. Why? Large cap, strong economy. We don't need to be that defensive. Low beta, we're expecting a strong economy. We don't need to be defensive. We can go with value stocks. We can go with small cap. Now, if under large cap, you say, we're expecting a strong economy, and a strong economy, I prefer small cap over large cap. You get the points for both large cap and small cap. So if you say that, you got it. So it's not that you have the bullets, but I would still repeat myself. Small cap, I want to overweight. They tend to outperform in strong economies. And high beta, I like that. Developed markets, we already said that. Europe's weak, the strong dollar. Emerging markets, that's obvious. And maybe alternatives from extra diversification. All right, you're kind of seeing the pattern here. So we'll keep practicing and practicing this. So the key is not that you do well on an exam. The key is that you do well in life. So we got to get used to kind of just automatically, the real key, I call it spatial intelligence. You hear a phrase and you can see everything. Right now, you're probably having to think too much about it. Oh, wait, what do you do? That's when you, once you get into the career, you don't have to think about it. Wait, interest rates rising, what do I do? You just, your mind just automatically says rates rising. Yeah, we're going to shorten duration. You don't even have to think about it. So we got, how do we get you from thinking about it to it's just automatic? And that's what we're going to try to do practice with this, Camille.
And those like topics, those bullets, that's from the scenario you gave us on the previous meeting.
Yeah, I give you a scenario
Got it.
and then I give you a list of asset classes. And some of them will be really similar each time. So here's another one. Your boss has provided this next forecast. I believe the looming fiscal cliff. This is many years ago. The fiscal cliff. So this was, I mean, it sounds like we go through this every year, but we were hitting the debt ceiling. And so they wrote this law that said, we don't fix the debt ceiling, we have to automatically cut everything. The Republicans are like, see, we got you. And then they go, oh, wait, we're going to cut the fence. Wait a minute, we don't like it. So it was kind of confusing for them. But that was it. We're going to automatically cut all government programs across the board. And people are saying, what's that going to do? So I believe the fiscal cliff and Europe's sovereign debt crisis is going to send the U.S. into recession. What is this sounding like? You already got 60% of your answer. What about long-term treasuries here? And why? Why do you want long-term treasuries?
Yeah.
Rates are going to fall, so you like the long term. And recession, so you like high quality, right? I'm hoping you are getting this because a lot of students will do that. Japan following suit, Europe continue to be in recession. Economic corporate earnings growth will be well below historical levels. However, emerging countries should see decent economic growth. So if you're going to do international, emerging might not be a bad place to put some money there. Inflation should remain well contained. I expect interest rates to stay in a very tight range. So there I told you something about volatility of interest rates. So rates going to be volatile or tame? Very tame. What do you think about mortgage backs? That might be a pretty good asset in this, like high quality, and you get that extra bonus of the spread for the optionality. This might be a great place to be. With most of the developed market debasing its currencies, US dollar will hold up well. So you've got true reasons to avoid developed markets. Their economies are weak and the US dollar is going to probably hold up pretty well. Not concerned about inflation, so diversifying real estate. So I'm not sure diversifying real estate makes sense. So just gave you that straight out. Plus, these are expensive assets. However, we should continue to seek other ways to increase diversification. So what does that mean? You're kind of the only thing you're left with is venture capital. Because if you're not worried about inflation, commodities probably aren't going to be that strong. I mean, commodities need inflation and a strong economy because they're kind of both of those things. And then the tax rate at the end. All right, you're seeing the pattern here. So what I'll give you in practice, probably on Tuesday or Monday, we'll do this. Not the team question, but I'll give you another previous exam where I'll print out exactly what you're going to see on the exam so we can practice so you'll see just like what it's going to be. So I give you the answers, but you see 2 bullets on the treasuries, 3 bullets on their corporates, 1 bullet on the mortgage backs, stocks and bonds that were all 1 bullet, large cap, low beta. It's 2 bullets, but I didn't make it 2 bullets. But so you see how it's going to start getting a little redundant if we just keep practicing this over and over again. But the key is that you're fast, right? You got to get out of the stop and think about it mode. And I think that's what multiple choice does to you. You're thinking multiple choice. You can't think multiple choice. Some students view this question as like a true false question. It's like, okay, I got 50-50 chance. I'll say overweight. If you say overweight, you get 0 points, even if it's right. So that's not what I'm looking for. This isn't true false. So overweight might be the perfect answer, but it has to be what? Overweight because you got to tell me why. All right. Say overweight treasuries. Why? Well, I just overweight treasuries. That's 0 points. Overweight treasuries because we're expecting a recession and treasuries are high quality. That's where I want to be. Plus they're long duration and the interest rates are falling. You got to tell me why. Okay. All right. I'll let you out a little bit early today.